All right, so you guys, I'm going to do a training with my loan officers about how to understand capital structure. I figured it would be good for you guys to see this, so I'm going to record this entire thing, put it on YouTube. I talk about capital structure a lot when I used to take client calls. It's really the number one concept in finance that I would say is worth understanding. So I'm just going to send an invite to them. They'll be able to join I'm going to send it to them on our Slack, so they'll be able to join. And I'm just going to do the entire training live. Hopefully, this will be done with no cuts, and hopefully, they don't say anything stupid either. So, I guess we'll get right into it here. All right. So, this is recording, by the way. So, okay. So, Austin, George, I just told you guys this is going to be on YouTube. I already gave the intro, so you guys are on camera. I was like, hopefully, they don't say anything stupid. So. But I really figured that I wanted to record this. I told you guys a second ago, this is like the most important concept to understand in finance. It's arguable whether it's the most important. It's definitely one of the most important. You cannot argue that. But we left off a second ago. I was like, Austin, you've kind of dug into this concept a little bit. Do you mind explaining what you've learned? It's totally fine. If you say something wrong, don't be afraid of that. Just, tell me what you've read so far.
Yeah, Michael Milken kind of explained using a diagram, I guess, of a six-sided cube, explaining how finance and capital structure is there's a little bit more into it. He kind of said that instead of a two-dimensional plane, capital structure goes into a three-dimensional plane using this cube, where he brought in like ri risk adversity and stuff like that. And it's built up of company, industry, capital markets, economy, regulation, and society. And all six of these are intangible with one another, whether or not, um, the deal would structure itself properly. Now, I don't know how to go into more depth than that, but
Right.
that's my base understanding.
That's a really comprehensive explanation, actually. So it's like that's more in depth than what I'm going to be going into here. This is just going to be about debt and equity, like the
Hmm.
actual forms of capital itself. So it's just going to be about debt and equity. George, you've actually heard me like do a video breakdown of this slide before. I did a recording of this before.
Right.
It's super important. It was at Deep's house.
Right.
Now, do you want to give an explanation? Do you feel comfortable giving an explanation about what you think capital structure is just before we get into it? What do you think it's going to be? Just give it your
For,
best shot. If you don't want to try, then whatever.
for me, I feel like the capital structure is just going to be on just how it goes, like the guidelines, the basis,
Gotcha.
setting the structure of it. Mm.
Yeah, I mean, so what capital structure is, the best way that I would explain it is it's a good way to understand the cost of capital. Like there's this one investment banking equation called the weighted average cost of capital that every investment banker uses called WACC, to simulate what's going to be the expenses associated with any form of capital. But that's like a little bit complex for what we're going to use it for. We're using it for real estate, lower middle market transactions, so it's a little bit overkill, but um, capital structure, I would say, are just the building blocks. How do you structure capital? What do you put together? How much equity do you put in a transaction? How much debt do you put in a transaction? How do you know what's going to be the sweet spot for how much to finance clients and how much to finance deals for yourselves whenever you guys are buying assets in the future? So that's what this is going to be about. This curriculum explains how organizations use debt, equity, and hybrids to finance operations, yada yada. Um, okay, so what is capital? Really, money at its core is just going to be a form of stored information. So, uh, honestly, if you think about it, what money really is like a database that gives people the authority to assign or allocate labor. Is like that's pretty much it. It has no like it's fake basically outside of that. You could think about like if you're on an island Do you want food or do you want $100 billion? There's no way to use your $100 billion if you're on an island, so it's fake. It's literally not real outside of the constructs of our society. And so, like, at its core, what it is stored potential. Like, somebody who has $100 million can deploy it to do anything, right? So, like, how do you value that? It's really just potential. And it's deployed to generate more value. So capital implies the possibility of growth, reproduction, or leverage. There's different types of capital. Michael Milken talks a lot about human capital, which, funnily enough, isn't on a balance sheet. Like you'll think about, for example, like Walmart. Walmart is valued based off of its revenue and expenses, and equity. It's not valued based off of its million people that work for it. Like that value is not on the balance sheet for Walmart. Um, and so that's something interesting to think about, and like as you move throughout the world, um, and finance businesses, finance real estate acquisitions, the human capital aspect of it. How do you weigh that in a transaction? Like, because you don't finance a really experienced real estate investor the same way you would finance a novice real estate investor who has no deals. Because there's two different forms of human capital there. You can give more leverage. I would encourage you honestly to give more leverage to somebody who's really confident in what they're doing and has done it a million times before than to get leverage or put leverage on a deal for somebody who's doing a deal for the first time because they might fuck a lot of things up. So there's that human capital aspect there. Social capital as well. You guys should think about how much social capital you have. That's relationships, networks, trust. There is some social capital that you can build. There's intellectual capital that you can build as well. How much intellectual capital do you have? Something to consider. You don't think about those things actively, but I encourage you to. This is going to be, we're not going to be talking about these other abstract forms of capital. We're going to be talking about money, financial capital, so specifically debt and equity, and why these things are even different or what they are. So, you guys know what debt and equity are.
Hmm.
Okay, George, what is the difference between debt and equity?
What? I was lost. Sorry, my bad. I'm doing Yazin's pre-calls. I mean Yazin's
Uh,
follow-ups.
no, it's fine. Just what's the difference between debt and equity? What do you think is the difference between debt and equity?
That is money that you're gonna have to pay off. So even if you collect that money, it's not your money. And then equity is the money that you have rather than or lose.
Okay, yeah, it's pretty it's not too far off. Basically, there's some hybrid securities which we'll talk about at the end of this that's beyond the scope of this conversation, but every form of money is either going to be debt or equity. And they both represent two different sides of the capital structure, and they really represent two different forms of risk and control, etc. So if you understand the difference between debt and equity, really just that's it, because there's different forms of equity and different forms of debt. If you just understand the different characteristics and qualities of debt and equity, you'll be able to finance transactions. Now, a lot of people don't approach deals that way. They just, see a flat purchase price, a deal for $1 million or $100,000. They don't know where to start because they're not seeing that there's a clear distinction between the 20% down payment being equity and the 80% uh, leverage being debt. They don't see those different characteristics, so they can't begin to structure capital at all because they're not seeing it in that way. They're just seeing $100,000. Um, so equity, the best form of equity I could give you, the best analogy is going to be venture capital. So venture capital is like the best form of equity finance for you to understand because they finance risky projects that can capture ridiculous upsides. Okay, but they don't collect a fixed premium, so there's no guarantee that they're going to make their money back. They invest into super risky things. So you might have a venture capital company or a VC firm invest $1 million into like some app startup or tech startup. And that's their $1 million. Like either it goes to 100 million or $1 billion, or they lose their money. That's it. But they get this uncapped upside. There's no cap to how much money they can make, but they're taking on a lot of risk. That's equity. So there's no cap, there's no ceiling to how much money they can make. There's just no guarantee they're going to make any money, so it's extremely risky. Um, which we'll see is a little bit different from debt. It's actually the exact opposite. Debt is the opposite. So again, just to hammer that point in a little bit more equity, you want to think of VC companies. You want to think of an uncapped upside, but no guaranteed return. So it's completely risky. They can capture ridiculous upsides if they don't lose everything, and it's risky. So it's money provided in exchange for ownership of an enterprise. It's like money you'll put up, you'll get a rev share. Maybe you might make a lot of money on that rev share, but you don't know if you'll ever see it through because maybe the company will fail before your rev share is worth anything tangible. Um, it's also variable. It's not fixed. You're not guaranteed to make 10% a year. It's completely very like it's completely random. It's a lot of risk. You can't model it out. You'd have to like pull assumptions out of the air to make projections for equity. But there's no fixed 10% or 15% that you're going to get or 5% from your bonds, which we'll see whenever we talk about debt. The risk profile, you can potentially lose everything. So it's extremely high risk, but it has an unlimited upside, so it's high reward. Equity is high reward, high risk. And equity holders own decision-making powers in companies. If you invest equity, you get board seats, voting rights. You can steer the direction which the company goes. So this is equity. Do you guys have any questions about equity before we move on?
Because we have this already, right?
Yeah, if you guys don't have this, you guys will receive this. So for debt capital, so debt capital is the opposite of equity, whereas equity has uncapped upside, but you could potentially lose everything. Debt is basically the opposite. You have really good security for senior forms of debt. You have really good security that you'll at least get your money back, but your upside is capped at if it's first lien senior debt, then your upside right now is capped at like 7.5 or 8%. If it's a bond, if you lend money to the government, you know you're going to get your money back because you're giving it to the United States government. So you know you're going to get your money back. You're guaranteed to get your money back, but you're only going to get 5% a year. It's the total opposite of equity. Um, so what's the definition? Actually, what's the analogy? So banks are the perfect example of debt financing because they don't finance any risky projects, but they capture predictable yield. So like what sort of you don't see banks investing into like a technology company. Usually whenever you go to a bank, you're going to need tax returns, a good credit score, nothing on your credit profile. You need to like fit into all these hoops and loops. You guys know our guidelines packet's extremely extensive. How do you even read a guidelines packet? You have to like learn how to read a guidelines packet and then read the guidelines packet. It's like extremely very like curated. There's a lot of matrices, sorry. Um, that's just because we're financing with debt. So we don't want to take on a lot of risk. We want to capture predictable yield. If you think about lending money to a real estate investor, you know that your loan is secured because you have an appraisal report, you usually have a lien on that property, so the investor could go bankrupt. You'd still get your money back because it's secured by the property's cash flow, the DSCR, remember that underwriting concept, and also the collateral value of the property. So banks are the analogy for debt. They don't finance anything risky, but they capture a guaranteed return. Debt doesn't capture any guaranteed return, but they have an unlimited upside, and they're extremely risky. So, what's the definition? Money loaned with a contractual promise to be repaid, typically with interest. The return profile fixed. It's fixed. Debt holders receive scheduled payments. The risk profile is basically none a lot of the times, depending on how the debt is structured. But there's no upside. There's no shared upside. Then again, you have basically no ownership. You just have collateral rights. So the trade-off. Equity is high risk with high growth potential. It attracts long-term investors, but it dilutes ownership. Debt is low risk and predictable. So now, you have these two forms of money, debt and equity, but then you want to tie that to your understanding of capital markets. How do you get this money in the first place? Like, who is giving the investors that we're funding money? Um, it's the capital markets. And so like, you want to think about there's these two buckets of money in the US, investors that have an appetite for risky projects, like your VC firms, Like you guys can now go and become venture capital. Obviously, you're gonna have to practice and stuff, right? But you guys can now go out and become venture capitalists because you understand that whoever you're gonna raise money from is looking for a high outsized return with no guaranteed, with no guarantee. Now, if you want to raise a debt fund like a private credit fund, you know whoever you're raising money for is looking for the safest, predictable asset to invest in with the highest guaranteed percentage yield, but they want something predictable. So debt is low risk and predictable. Equity is high risk with a lot of growth potential. So this is going to be our bridge to capital structure because they interact on every single transaction. Um, so no project pretty much relies on one or the other. Everything is using a combination of both. Now, how do you balance those two things? That's what capital structure is about. So debt and equity are combined into a capital structure. Understanding capital structure from concept to history. Obviously Michael Milken popularized the concept of capital structure, made it super in vogue by pioneering junk bonds. That's the blueprint of how a company finances its operations and growth. Like, how do you decide whether you should raise equity or whether you should raise debt? It matters because you can run what the cost of capital is. Like, how do you decide whether or not, if you're going to do a partnership with somebody, how do you decide between doing a rev share where that person gets a percentage of your future profits or just getting a loan where you pay back 7 or 8% a year? How do you make that calculation, right? That's what capital structure is about. And more importantly, how do you help your clients walk through the mental journey of how to make that calculation? So you want to really like explain what's at stake here. You just want to give them you want to add a lot of context to the mental model that is capital structure, cost of capital, etc. So this is the capital stack. This is pretty much the singular thing that changed my life. It's this thing right here, this cube. Um, so there's different forms of debt. There's different forms of equity. This shows a bunch of little slivers of them. So at the top, we have asset-based loans. That's senior secured debt. That's the cheapest form of debt with the lowest interest rate, the highest probability of getting repaid. As we go down, we have junior debt has a higher interest rate, a little bit lower likelihood of getting paid. Then you have mezzanine debt, which is unsecured, typically has a really high interest rate and even lower chance of getting repaid. And then you go into preferred equity, which is a hybrid security, which is a mix. I said we're going to talk about hybrid securities now. We're just preferred equity, basically what it is like, it pays you a fixed percentage, like a bond or like debt, and it gives you some upside potential, but it caps out. So it's not uncapped upside, it's capped, and it pays you a percentage. So it's a hybrid security. There's full billion-dollar funds that are designed specifically to invest into preferred stock of companies, preferred equity in real estate projects, because this hybrid security is pretty sexy. Also, Michael Milken, thanks for popularizing that one. And then common equity. So uncapped upside, completely uncapped, but no guaranteed rate of return. So the capital stack is like a continuum of risk, where at the top you have the lowest risk with also the lowest interest rate, and at the bottom you have the highest risk, but also the highest potential rate of return. So it's like a continuum, the capital stack. Does that make sense?
Yeah. The
Okay.
higher you go, the less risk there is. The lower you are, the more risk there is.
Yes, exactly, exactly. So we want to think about this from two different lenses. The two lenses are like the two sides of capital markets. So on the one hand, you have your banker or investor, and on the other hand, you have your business owner. Those are the two sides of the capital markets. Because this investor or financier, banker, whatever, is looking for a rate of return on their money. They have $1 billion, maybe even more. In the case of Blackstone, they have managed more than $1 trillion, and they need to earn a rate of return on that money. Now you have your business owner who doesn't have money. He needs money to do his deals. So like this two capital markets, by the way, we live in the greatest country on earth for capital markets, the US, where you can raise money by doing anything. Basically, if you have a pulse, you can raise money in the US. You don't need anything else. So like some programs where you can have a 20 credit score and still get $1 million loaned. So it's like, we live in like a beautiful place where you can get access to capital. It's not like that in other places. But you want to understand these two perspectives, specifically the investor perspective, who wants to earn a rate of return on their money, because if you understand that perspective, you have a greater understanding of how to allocate capital, which is the understanding that you need as a business owner if you want to earn a high rate of return. So they kind of play hand in hand. They're the two sides of the capital markets. From the financier's perspective, this is the person who has the money, okay, and they need to provide the capital for the business owner. The capital stack is like a menu of trade-offs. Like, okay, I can invest equity into this project, but I'm not going to have a guaranteed rate of return. Or I can invest debt into this project, but I'm not going to have upside potential. So for the financier for capital markets, that's what they're thinking about. It's a trade-off. That's how you think about the capital stack. So at the top we have asset, senior debt, or asset-based loan. Senior debt is where your mortgages are at. They're at the very top. They're senior secured debt. By secured, that just means collateralized, has collateral. So our loans have collateral. Our mortgage loans have collateral because there's liens on the property and they have predictable yield. Um, Unsecured or mezzanine debt, like some of our structures, we have a combination of senior secured debt and mezzanine debt or unsecured working capital, both in a transaction, because as we'll see later on, or actually as we just saw, if you understand the capital stack, you can understand there's different sets of debt with associated costs. What's the DSCR of the overall transaction if you stack different forms of debt together? So that's why I said at the top of the call, this is going to be the concept that ties everything together. Now, for the person who needs the money because they have a business idea, for the person who needs the money, for the person who needs the money, it's the polar opposite. So for them, the capital stack is a menu of trade-offs, basically. Like they need the money, but which form of money is going to be best for them? And that's basically what clients are going to be coming to you for. They don't know what form of money is best for them. They just need to ask some questions and figure it out. They don't know what's the best way to finance their deals because this is a full-time thing. And on top of that, like we discussed before, either most mortgage brokers don't care to help them or they just don't know what this is or how to structure capital. So again, whether they don't know or they don't care is irrelevant to us. What's relevant is that our clients come to us a lot of times not knowing what any of this means, and we need to synthesize these like pretty expansive concepts into like easy to understand bite-sized lessons on our calls whenever we're talking to them and whenever we're in deals with them, helping them think through things. Okay, so framing the contrast. The financier looks down and says, how safe is my money? What return am I going to get? The operator looks up and says, how much control do I lose and how much flexibility do I have? So for the financier, it's about risk-adjusted returns. For the operator, it's about control and fragility. So an investor, like some business owners or operators for them, might be better to raise debt because they're fine with having a fixed monthly payment every month. They'll figure it out, right? If they think their business is going to do $10,000 a month in 3 months, they don't give a fuck about paying $5,000 a month for debt. They don't care. They'll figure it out. For other investors, for other business owners, they don't know, they're not confident that they're going to be able to make that $5,000 a month payment, so they'd rather partner up with an investor to give them $100,000 for like 10 or 20% rev share. Does that make sense?
Yeah.
Yeah.
Okay, perfect. So, why does this matter? This is why you're learning this. Okay, I kind of talked about this a second ago. Our clients come to us not knowing what any of this means. Like they have some baseline understanding of it, of course, don't get me wrong, but at the end of the day, this is a full-time thing. Like this is the only thing I didn't pick to be this way, okay, for me to like be like the one thing my brain has like an autism spasm about, like where I can just read about this all day. Um, but like this is a full-time thing. It's like a lot of things to stay on top of, right? There's always going to be different pools of money popping up. Like, what's attractive in this interest rate environment where rates are relatively high could be mezzanine debt because, it could have maybe a fixed rate now, whereas before it could have been variable, or maybe right now equity financing is going to be better. And so as financiers, we always want to be looking for pools of capital where those capital partners can get an attractive rate of return, but then our clients, the business owners, can still get financing that is not too expensive for them. So, we're this bridge between capital markets and business owners. So money has a price, as we've come to understand. There's just different forms of pricing, right? Um, the way that you would price debt is different than how you would price equity, and there is cost of capital, as we've kind of discussed. So the cheapest form of money is senior secured debt, which is in our case mortgages, first lien mortgages. So they have the lowest interest rate. They require the most collateral. Whereas equity, it's really expensive because your 5% rev share can one day be worth $1 million or more a month. So it's really expensive because it's uncapped, whereas this one is capped. Also with equity, you give up control, you don't have all the board seats, you don't have voting rights. What do I do with this property? I have a partner. What does he want to do? XYZ. It's really expensive. Why costs differ, the driver. So, the reason why mezzanine debt or subordinate debt or junior debt, as the spectrum kind of goes along, the reason why it'll be more expensive is because they have more credit exposure. So, mezzanine debt has basically 100% credit exposure. There is basically no guarantee that they're going to get that money back. They're just doing it's based off their underwriting. Whereas senior debt, since it has a lien, since they have collateral, they have very minimal credit exposure. So if you loan $100,000 to somebody who's buying, or if you loan $80,000 to somebody who's buying a $100,000 property, if that property appraises for $100,000, there's only $20,000 of credit exposure. Because if that person goes bankrupt, the lender will always be able to take that property back and sell it for at least $100,000. So they'll always be able to get that $80,000 back. They only have $20,000 of exposure. Does that make
Okay.
sense?
Yeah.
Okay, so capital structure basically is about capital structuring. Good capital structuring is about blending the cost of capital to be as low as possible. So, for example, right, you might have like here's a good question. Why would 50% senior debt be worse than 75% senior debt if you're going to put junior or subordinate debt behind it? Are you ready to answer that question, Austin?
No, not really.
Okay, so the reason why is because senior debt is always the cheapest form of money, since it's always going to have the lowest interest rate. So you always want to have the biggest percentage of your purchase price be made up of senior debt. So in our case, it's going to be 75 or 80% LTV, or in some cases, 85% LTV for senior debt. And you want the lowest possible percentage of any junior debt, subordinate debt, or mezzanine debt, or unsecured working capital. You want to have the lowest percentage of that make up the purchase price because it has the highest rate. It's a more expensive form of capital. You want to use as much senior debt as possible. So when we start to layer these together, we can engineer a capital stack. Um, so great financings layer instruments together to protect risk and cash flow timing. So you want to start at the top. How much senior secured debt can I put on this? How much can this transaction comfortably support? And then you want to bridge that gap. After you layer on as much senior debt as possible, you want to backfill how much mezzanine debt can I put on this without the debt repayments becoming too expensive. Does this make sense?
Yeah. Yeah, because the senior debt is the mortgage, right?
Mm-hmm.
So using as much of that as possible means you're using as little risk as possible. Then the mezzanine debt is like a combination of both. So when you put it in there, you're not lo the not only are they losing less control, um, the client would be, but we'd still have a bigger margin of air or cushion to get that money back.
Exactly, exactly, because your DSCR can stay high if you have a lot
Hmm.
of senior debt. Whereas if you have a lot of mezzanine or junior debt, since it's more expensive, your
Hmm.
DSCR becomes lower. That's exactly correct. So there's an art and a science to this. I'm actually writing a book called The Art and Science of Capital Structure. Because there is an art to this. There's no like 100% right way to get it. There's really like an art to it. A lot of times depends on the human capital in the deal, like whether this operator is going to be able to execute on this 100-unit portfolio comfortably. You want to find like you want to layer on a lot of debt, whatever, he'll figure it out. Not exactly. But he's comfortable he can figure it out. Whereas like if you have somebody who's completely new to real estate and he wants to buy 100 units, he should not be at 90% LTV. He just shouldn't be. Now we obviously like think that there is a value and a beauty to this, so we want to make sure that the DSCR is always as high as possible, regardless of whether it's going to be at 90% LTV or 75% LTV or 10% LTV. We want to make sure that the DSCR is always high because if the DSCR is high, there's sufficient coverage over the debt service, right? Remember that? That was lesson one. Also, if the DSCR is high, but the person has no liquidity, that's also a problem, right? We talked about that working capital. Um, we also want to make sure that there's an exit path. Um, if there is potentially if we finance a deal with a high cost of capital, but it's only a short term, like it's like a bridge financing for whenever he's going to refinance out later into like a long form, like a long-term form of capital that has a lower rate. We want to make sure that there's a clear exit path. So if a client is going to do a fix and flip, you want to make sure that he's using conservative assumptions on what the after repair value of that property is going to be. Because if he's using an optimistic assumption, the property underappraises, he might not be able to refi and pull his money out, and he's going to get stuck with expensive capital, right?
Hmm.
Okay, so this is why this actually matters. Right here is this part. So you want to use a lot of, I don't want to say you want to use a lot of debt, but a lot of the times the reason why people will be looking for higher loan to value percentages in transactions is because leverage boosts return profiles. So we've talked about this before, in one of our other
Cash on
trainings.
cash.
Yeah,
Yep.
exactly. Exactly. That's exactly correct. So this is the math to it. Leverage magnifies equity returns if cash flows are stable enough to carry debt through stress. That's why your DSCR matters. It measures your ability to service the debt. So, I mentioned this is going to be the one that brings us full circle. We started off with a metric to underwrite deals. This is actually putting the capital together for whenever you need to underwrite deals or how to underwrite deals whenever you're putting different forms of capital together. So, one really cool thing, your homework for today, we'll talk about this once we're off camera, is going to be about leverage buyouts. What did Milken do? Why is he like so impactful? So it's not just the fact that he pioneered junk bonds, or that he popularized capital structure. It's that he pioneered junk bonds at a time when this new investment strategy at the time called leverage buyout was becoming popular. So how do you finance a leverage buyout if a lot of companies at the time are only willing to lend out senior debt? You can't. So somebody like Milken steps in and like basically pioneers the middle form of the capital structure at mezzanine debt, junior debt, preferred equity is really what he was doing, as not senior debt or equity. He was like in the middle. Um, So he's bridging the gap for a lot of people that wouldn't otherwise have been able to afford big transactions. So at the time they were called leverage buyouts. They're still called leverage buyouts, but the industry has evolved because now there's big trillion-dollar companies like Blackstone who are doing leverage buy. Like every private equity company right now f does leverage buyouts. It was Milken who popularized the how to finance them. Does that make sense?
Hmm.
That's why Milken is actually popular. It's not that like um, junk bonds are super in vogue today. They're a multi-trillion dollar market, but more than that, his lasting impact was like he created the basically like the methodology for how to finance leverage buyouts, which is a really good way to earn uh, a high return on invested capital because you can leverage up a lot in a deal. The same way that you'll finance a real estate deal where you do 80% LTV, you can do that exact same thing on a business that's worth a couple billion dollars and sell it in 5 years after you improve it. It's the exact same process from a financial standpoint. It's literally the exact same thing. So this is a good place to learn, which is in real estate, there's a lot less variables, right? There's tenant occupancy rate, and that's it, pretty much. That's the main variable. Whether or not your tenant's going to fuck up the property, that's another variable. Whereas like in a business, can you run this business with what if the employees quit? What if like something in XYZ breaks? Like what if whatever? There's a million things, like a million variables. So consider. Let me like I'll ask you guys now because in the world of businesses, you can go to 90% loan to value or 95% loan to value. In industries where there's a bunch of variables, there's l way less predictability than real estate. But for some reason, in the world of real estate, traditional mortgage brokers, traditional investors will stop at 80% LTV, or in some cases, 75% LTV. Why? Is my primary question. Why? Either they don't care or they don't know. How could they not know? This is so simple. Um, so I don't think I need to run this calculation with you guys because you guys already did it. You guys want me to do it again? You guys have it.
I think it's fine.
Yeah, I think you're good.
Okay, so putting it together, we kind of already did that as well. So building a best available stack, our loan officers do this for you. So this is you guys. You guys will be doing this for our clients. Where you want to underwrite the base cash engine. What is the NOI on this deal? And then you want to backfill senior debt. Like what's the maximum amount of senior debt this lender is willing to give on this deal that this client qualifies for? Can this deal support any mezzanine financing? If it can, how much can it fit in? What is the DSCR if it's, 10% or 5% LTV mezzanine or junior debt? How's the DSCR change if we add more debt to this transaction, etc. Main takeaways. Equity is the most expensive form of money because it buys you upside and control. So you can say, I don't want to sell this property, or I want to sell this property in 5 years when it's worth more, or I want to reinvest money into appreciate or I guess improving this property so that it'll appraise for more. But with that control, you can lose all of your money. Now, on the other hand, senior secured debt is the cheapest because it has the strongest claim. You can lend your money to a grade A investor who's buying a good piece of real estate. You get an appraisal, you're almost guaranteed you're going to get your money back. And if he doesn't pay his coupon, his 7 or 8% a year, you can default. You can make him go into default. Defaults on the loan, you get your money back. So it's the safest. Now, as you move from senior down towards equity, capital progressively gets more expensive. We talked about that. So junior debt is maybe going to be 10%. Mezzanine debt is going to be 15 or 20%. Preferred equity is going to cost you control and still pay a coupon, and equity is going to cost you basically 100% control. So, what's going to differentiate somebody who's a professional versus somebody who's a novice at structuring capital? So, you want to layer your instruments correctly so that you can have the lowest possible weighted average cost of capital. So, you could say somebody's a shitty capital structure person or capital structure if they do like 100 or 75% junior debt and then like 5% equities. Totally backwards. And then obviously, this is the slide that we skipped. Leverage amplifies equity returns. but only when the cash engine supports it through stress, not in the base case. So if you're looking at a best case scenario whenever you're doing projections with your clients, you're doing it the wrong way. You want to look at if everything goes wrong, will my client still be able to survive this? Will the deal still be able to survive this? Will the debt still get paid? All right. Combining working capital and DSCR loans to scale. Basically, what our company is number one in the world at is combining these two things to scale. So, for some reason, at our end of the market, the world of real estate, nobody does it. I don't know why. I cannot figure it out for the life of me. Why people do not do this. So baseline. Every single company finances their operations using different tranches of debt, except in the world of real estate for whatever reason, which I find to be amusing. So, scaling flywheel, yada yada. You guys have any questions?
No, I
Um,
mean you explained everything pretty well.
I have no questions about this,